how you can expect to pay as an overseas buyer. No stamp duty on the first £300,000. Stamp duty, land tax. Choose to stagger their acquisitions. The total is $15,500 in stamp duty. Hey there, it's Andrew here. If you're thinking about buying property in the UK, especially as an overseas investor, there's one cost that can really sneak up on you. Stamp duty, land tax. Now I get it. Taxes aren't exactly the most exciting topic, but understanding how this one works can save you thousands of pounds and prevent some very expensive surprises. So in this video, I'm going to walk you through what stamp duty land tax actually is, how you can expect to pay as an overseas buyer, what's changed recently, including April 2025 updates, and some of the genuine ways you can reduce your tax bill, whether you're buying one property or building an entire portfolio. Let's get into it. What is stamp duty land tax? Stamp duty land tax, often called SDLT, is a one-time tax you pay when you buy a property in England or Northern Ireland. It's based on the price of the property you're buying, whether you already own other properties, whether you're based in the UK or overseas, and the type of property. Residential, commercial, or mixed use. So it's not a one-size-fits-all thing, and that's where people often get caught out. Let's say you're buying a residential property as your only home. Here's how stamp duty is currently calculated. No tax on the first £125,000, 2% on the portion between £125,000 and £1 and £250,000, then 5% on the portion between £250,000 and £1 and £925,000, 10% up to 1.5 million and 12% above that. If you're a first-time buyer, you get a nice little perk. No stamp duty on the first £300,000, as long as you're planning to live there yourself. Sounds reasonable so far, right? But here's where things get more expensive. If you're buying a second home, a buy-to-let, or you're not a UK resident, the stamp duty bill is much higher, especially from the 1st of April 2025. For those kinds of purchases, the government now applies 5% on the first £125,000, 7% on the next £125,000, 10% on the amount up to £925,000, and then 15% up to 1.5 million, and a whopping 17% above that. On top of that, if you're based outside the UK, you'll pay an additional 2% surcharge as a non-resident buyer. So even if you're buying just one £300,000 buy-to-let, you could be paying £20,000 or more in stamp duty, just in tax. It's a lot, and it's easy to underestimate when you're planning your budget. Now, before you panic, there are some perfectly legal ways to reduce what you pay. Let's start with one of the most underrated strategies. Buy mixed-use property. That's a building that has both residential and commercial elements, like a shop on the ground floor with a flat upstairs. These are taxed at non-residential rates, which are often much lower. Buy through a UK limited company. Yes, company purchases do attract higher rates, but they open up the door to tax planning. You can offset expenses, access mortgage products tailored for landlords, and potentially reduce your ongoing tax liabilities. I'll cover this in depth in a future video, so make sure you subscribe if you want to learn more. Buy 6 or more units in one transaction. This is called the 6-pack rule, and it allows you to pay a flat 5% rate instead of the higher residential rates. You don't need to be a big-time developer, just someone with the capital and the right deal. Even if you're not there yet, it's something to keep in mind for later. Plan your purchase timing. Some investors choose to stagger their acquisitions or structure the deal through partnerships, trusts, or staged completions, all of which can impact the tax owed. But here's the key takeaway. Plan early. Don't wait until your solicitor sends the invoice. Model the costs upfront and get expert advice. It could be the difference between a good deal and a stressful one. Let's take a very normal example. You're based in Singapore and buying a £200,000 buy-to-let in the north of England through a UK limited company. From April 2025, here's how stamp duty stacks up. First, £125,000 at 5% is £6,250. Next, £75,000 at 7% is £5,250. Add 2% surcharge, which is £4,000. The total is £15,500 in stamp duty. But if that same property is part of a mixed-use building or part of a multi-unit block purchase, the total stamp duty might fall significantly. That's why having the right structure and the right team behind you is so important. This is exactly what we help overseas investors do every day. At Avantus, we set up your UK limited company, connect you with accountants and mortgage brokers who understand international buyers, help you find the right property in the right area, and make sure your deal is structured smartly, so you're not overpaying tax, fees, or interest. If you want to find out more, book a quick call if you're ready to start building your portfolio. And remember, just because you're based overseas doesn't mean you have to do it alone. Subscribe for more videos like this one and leave a comment if you've got a question. I reply to everyone personally. Until next time, invest wisely and make your money work harder than you do.